morning. Welcome to ANZ News. It's Friday, the 30th of April. Touching base on WGC's gold demand trends for Q1 in 2021 today. The World Gold Council have just released their quarterly update on gold demand and supply, and we summarise the key excerpts as follows. The US dollar gold price fell by 10% during Q1. The recent downward trend was fueled in part by ETF outflows and a reduction in net long positioning in the futures market, but strong consumer demand helped provide support. Here's that chart here showing gold demand held steady. ETFs. Gold demand ETF holdings fell by 177.9 tonne, or US $9.5 billion. Western markets drove outflows as US rates rose sharply and the US dollar strengthened. Another little chart here showing the largest global gold ETF outflows since Q4 2016. Bullion. Demand for gold bars and coins saw a third successive quarter of growth. Investment in these products reached 339.5 tonne, the highest quarter since Q4 of 2016. Bar and coin investment was buoyed by the opportunity to buy at lower prices, as well as by expectations of building inflationary pressures. Bargain hunting in key markets, notably China, was a major driver of growth in this sector of demand as the gold price fell back from the 2020 peak. Fear over rising inflationary pressures was an added driver as economies around the world responded to the massive fiscal and monetary stimulus introduced to combat the worst impacts of the pandemic. Here's that chart here showing retail and bar and coin demand jumped to 17-quarter high and above 5-year average. As you can see from those tables below, we're going to show you China's bar and coin demand totaled 86 tonne in Q1, or 133% higher year on year and 21% higher than Q1 in 2019. We discussed how this is likely just the beginning of renewed Chinese demand in previous articles. Little chart here showing that too. Jewellery. Jewellery demand totaled 477.4 tonne in Q4, up 52% year on year, a strong improvement compared to the historically weak Q1 in 2020. Demand remains muted on a long-term basis, 6% below the 5-year quarterly average of 505.9 tonne. India and China were the engines of recovery, generating the vast majority of global year-on-year growth. Little comparison chart here for you to see that too between India and China. Central banks. Global central bank gold reserves grew 95.5 tonne in Q1. Hungary's large purchase of 63 tonne bolstered the Q1 buying, more than matching Turkey's substantial sale of 31.5 tonne. A chart here showing central banks bought a healthy 95 tonne in Q1. Hungary, the biggest buyer of the quarter, hasn't bought gold since 2018 and stated they were managing new risks arising from the coronavirus pandemic. Also played a key role in the decision. The appearance of global spikes in government debt or inflation concerns further increased the importance of gold in national strategy as a safe haven asset and as a store of value. Technology. Demand in the technology sector during Q1 rose 11% year on year to 81.2 tonne. The electronics sector, which accounts for the majority of industrial gold demand, registered 13% growth year on year to 66.4 tonne. Other industrial demand grew by 9% year on year to 12 tonne, while dental demand continued its slow decline, falling 9% to 2.9 tonne. Supply. Q1 mine production increased 4% year on year as coronavirus disruptions abated. However, the base effects of that coming off a much lower base due to COVID shutdowns meant the total was not materially different to historical rates. Recycled gold supply fell 8% year on year due to weaker gold prices and diminished stocks. Producer de-hedging of 25 tonne was noted, continuing the full year 2020 trend. This chart here showing mine production, showing strong rebound. As we sit here now amid rampant monetary expansion with no end in sight, the previous charts is a salient reminder of the reason gold is real money through scarcity. On average, over the long term, the supply of gold expands by just about 2% each year. That previous chart above, or the one you've just seen, also reinforces the widely held belief that we saw peak gold in around 2015 to 16. You can see the downward trend since. The key takeaway is that while the fleeting Wall Street money is leaving ETFs for bubble-like financial assets, the strong hands are buying up physical in the dip at a strong rate despite the everything is awesome narrative everywhere else. Great stuff there. From WGC Gold Demand Trends, Q1 2021. Thanks for listening. Remember anzbullion.com.au for all things physical, anzwealth.com.au for all things cryptocurrency, and goldsilverstandard.com for our own cryptocurrency built and backed by Ainsley. Enjoy your weekend. If you're having a long weekend, enjoy that even more, and we'll catch you next week for more news.